So you want to be a Forex trader. Hey everyone, this is Joshua Martinez from Marketers Institute, MTI's product expert. This is video 5 of our video series, so you want to be a Forex trader. Our last video, video 4, was all about Japanese candlesticks, going over the combination of the candlesticks which cause U-turns on the way up as well as U-turns on the way down, and we even gave away that cheat sheet as well, which was a nice little PDF download. Today we're going to talk about hand-drawn trend lines. Hand-drawn trend lines serve a very strong purpose. They actually do 3 things. They let you know market direction, either market's going up, market's going down, market speed, how fast or how slow the market is, and the third thing is trading opportunities, whether you want to buy or whether you want to sell. So let me go ahead and give you an example. We're going to draw this out for you. So typically when the market moves, we're doing a up example. The market's going to make higher highs and higher lows, which is fantastic. And the goal or the objective here is to identify the lowest point of the trend and to identify the highest point of the trend. Now what you need to do with your imagination is you need to only view the market like this. Now I don't care if there's more market movements in front. If this is the highest point, that's all you care about. And I'm going to explain to you and show you why. And so then you want to connect your hand-drawn trend line. It will be in a straight angle on your software, whatever you're using, across the lows of support. Support just means a low. It's a fancy word for low. And if, by chance, this market breaks the uptrend line, that helps you understand, hey, there's a potential reversal. Now, there's like crown formations that we can talk about, but that's for another video. But if a mistake ends up happening is when traders draw their lows of supports across this low there, and they don't really keep in mind of the highest point. So don't ignore the highest point. Okay, so now I wanted to go ahead and give you that aspect, but let's go over the 3 types of trend lines. Okay, so you have your what's called the outer or your long-term trend line, and your long-term trend line is going to give you your big picture. Let's do this. So this will be a little simpler. We're going to do, okay, so your long-term trend line will literally be going back like a year to 2 years, depending on your time frame, maybe the monthly time frame, daily time frame, even a 4-hour time frame, and finding the big swing. And this is going to be considered your long-term trend line. Then you have what's called the outer trend line. And the outer trend line is going to be focusing in on the most recent push or the extension, like so. So you have your long-term trend line and your outer trend line. And then the inner trend line is when the market picks up speed and has like a big old spike, and it even does this. So you have 3 different types of trend lines. So what I want to do is I want to focus in on this. I'm going to erase everything, and I'm going to blow everything up and focus in on just this little section here. And the reason why I'm doing this is because you as a trader need to be well aware of the different angles and what they mean when they break. So once again, let's just pretend that you have a long-term trend line that is from years ago that says if or when the market touches this outer blue trend line, you're going to want to look to buy reversal. Then you have your outer trend line, which is the most recent push. So this is the market making higher highs and higher lows, higher highs and higher lows. You too want to buy this market when it touches this angle of support. And then if like a fundamental announcement comes out and there is a very fast and aggressive market and it pushes or makes higher highs and higher lows faster, you're going to have your inner trend line like so. So long-term, outer, inner trend line. So what happens if the market breaks the inner trend line? If the market breaks the inner trend line, usually the market will move towards the outer trend line and find support and bounce up like so. You as a trader, you need to be well aware of these areas because you want to buy those areas. Now, what happens if the market breaks your outer trend line? Well, if the market breaks the outer trend line, usually it will gravitate towards the long-term trend line. Why? Because the market speed is slowing down. Remember, trend lines do three things: determine direction, either up or down. They determine market speed. Long-term is your long-term trend line. Outer is when the market's making higher highs, higher lows faster. Inner is when it's very, very fast and very, very aggressive. When the market slows down, it will start breaking these trend lines and gravitate towards the previous one. Inner moves to outer, outer moves to long-term. You as a trader, you can use this information to kind of know where the market's going, when or if it's slowing down, and then we can look to sell the market from resistance to support. And then when it touches the long-term trend line, we can look to buy the market towards north there. We understand that some of you are probably kind of wrapping your heads on how you can apply this into the actual live market. What we wanted to do is we wanted to first to draw out the concept, and we're going to create another video where we're going to apply it into the actual charts, so this way you can see the visual view. For those of you who are kind of saying to yourself, hey, I get it, I understand it, and you want to continue on with the series, just skip video 6 and we'll see you in video 7. You can always follow us on Facebook, www.facebook.com/FX Pathfinder. You can find us on Twitter, Blab, social media. This is Josh Martinez from Marketers Institute.